Get some market conversations going. Prateek Parekh from Nuvama Group is joining us now to discuss market fundamentals, the top sectoral picks, and how he is looking at the markets at current levels. Prateek, good morning. Thank you so much for joining us on the show today. I was just looking at your report, and it's quite interesting where you talk about how consumption would bottom out in FY25, and there are some triggers as well, or select sectors that you like as well. Tell us more about it, and more focus on cyclicals, because this is a space you can't really time very clearly. So which are the sectors you're liking here?
Yeah, thanks, Sonam, for having me over. Last 1.5 years, we've seen a very big rally in markets. The rally has been led by cyclical sectors, and within them, more on the capex heavy ones like industrials, the defense, the PSUs, all of those ones. However, the discretionary consumption one have actually been left behind. Not only that, it's one of the very rare times where we have seen actually exports and private consumption both being weak, and yet cyclical sectors doing very well. Generally, cyclical sectors are a byproduct of consumption and exports. If both are weak, we seldom get to see such a scenario play out. Now, what we think of going ahead is that for F25, we see some green shoots of bottoming out in consumption. That is aided by 2 or 3 factors. One is clearly normal monsoon. The weak monsoon last year did have a hit on agri incomes and the lower end spending power as well, which I think should come back. So I think that should definitely provide some stability. Second is that consumption in general, is also having a statistical tailwind of low base, which in turn should help, the growth numbers look somewhat better from year on. And third, at least we think that from a relative basis, consumption companies, the earnings downgrade risk is limited. Expectations over year have been marked down, whereas those in the industrial space are still running quite high. And finally, if you look at the valuations and the relative performance, a lot of consumer companies is where the ideas now lie. Because on a relative basis, valuations are cheaper, and also in consumption, you have pockets which have underperformed quite meaningfully in last 1.5 years. Now, how do we go about selecting stocks or sectors in the consumption space? Our methodology is we look at a 4-factor framework of demand, competitive intensity, the cost, and the valuations. And based on that, we've come out with some sectoral ideas within the consumer pack, because within consumption as well, it's not like there's a buy or there are valuations are comforting everywhere. There are a set of companies or sectors where we think which are at the turnaround stage, and there are a set of companies or sectors which we think would be a potentially at the mature stage and could potentially face headwinds going ahead per se.
Prateek, good morning. Thanks a lot for joining in. And since you mentioned you have highlighted some sectors, would you like to share those with us? Which are the sectors that you have highlighted, sorry, as a potential turnaround story?
Yeah, so I think those essentially lie in the space which involve the low ticket consumption, which can be, for example, consumer durable space, where despite real estate sales doing very well, this is a space which has lagged behind. There we are seeing early signs of things bottoming out and demand perking up. The second will be those linked to rural consumption, which can be FMCG, or to an extent even QSR, where we have had, very weak demand, where things, at least from a demand standpoint, we see bottoming out. And also in some of these spaces, the competitive intensity is also reducing. For example, in the QSR space, at the current margin levels, you could see moderation in store additions, which in turn could perk up margins and SSG. Similarly, in FMCG space, while there are gross margin tailwinds are behind, companies are focusing on operational efficiencies to boost margins and profitability. And also with volume growth bottoming out or potentially rising, it provides a natural operating leverage of sorts. So I think from a turnaround perspective, those sectors or companies which have actually underperformed last 2.5 years is where we are getting more comfortable, which is FMCG, QSR, durables will be the top ones. And apart from that, telecom, airlines, we feel that and internet, we feel that the tailwinds are still in their side, and they should continue to have a good run going ahead as well, % mass.
Okay, so these are some of the sectors that you like. But Prateek, do you think rising costs, that could be a risk going forward, and that could squeeze in margins and profitability as well for some of the sectors?
Yeah, that's a good question, Sonam. I think, the tailwinds from lower cost were a big factor in FY24, especially I would say for auto companies, for auto ancillary companies, even to some extent paint companies. But the benefits were not broad-based. For example, if you look at FMCG companies, a lot of those tailwinds that they got from lower input prices were passed on to the end consumer. So I think in those areas where a lot of these tailwinds were kept with the companies, there I think profit growth could see a bit more moderation and move more towards top line. But I think there are spaces where a lot of those input price tailwinds, were eventually passed on to the consumer, and to that extent, the fact that the costs are now normalizing may not necessarily be a headwind for those sectors. So I think within sectors, I think autos, auto anchs, and paints is where I think the margin tailwinds going away could lead to profit growth kind of moderating next year per se. So is what I would put it.
Prateek, the thing about FMCG is that stocks in general always command a very premium valuations. If 50, 60, 70 times earnings, they may or may not perform as they haven't done so over the last 12 to 18 months. But would you believe that, okay, this is still, it may be an expensive stock, but there is now some value emerging considering the rural recovery that you are seeing? Or if one may wonder that why would you want to bet on an expensive stock with no returns, you'd rather bet on an expensive stock that still gives you returns, say the defense sector or like the PSUs?
Yeah. Again, a good question, Ramas. See, I think valuation is a relative game. We have to look at what is expensive and cheap in the overall market context. FMCG stocks were expensive, yes, at a time when rest of the market was, trading at half the valuations. Today, if you look at it, large parts of the market, even the cyclical ones like defense, in some PSUs, and a lot of industrial companies, valuations have caught up. I mean, today we are at a stage where FMCG valuations and defense or industrial valuations are exactly the same. You have FMCG where earnings or demand is depressed, and on those ones where demand is running on the higher side. Now, eventually, both of them should converge. Given the relatively low valuation differential between the two areas, I would rather bet on a space where I see some green shoots and things bottoming out, because I think small improvement should lead to a much bigger shareholder return as compared to some sectors like industrials or defense, where expectations are running very high. And given the growth setup of exports and consumption being weak, it is very difficult to believe that the demand in that space could continue. So I think from a relative basis, the premium that these companies used to command has come down quite significantly. And that's why I think the risk reward over here is far better compared to what it was, probably 5-6 years back.
That's right, because we've seen those kind of moves as well anyway in the stocks as well. Defense, PSUs have done so well, and FMC just started picking up, and that's something that we're seeing today as well. So there's some recovery from the lows for some of these FMCG names. Prateek, last question before we let you go on this conversation. You spoke about how exports are not picking up as well. Do you think most of the demand drivers for these companies, not FMCG, but the other names that you've spoken about, will be largely domestic?
Yeah. So I think that is what I think is somewhat beneficial, that for the other sectors in the consumer space, demand is more domestic oriented and also it is less cyclical. So I think the downside from that perspective is limited. I think the exports recovery will, if it happens, I think will further aid some of these companies because there will be spillover effects on consumption and so on and so forth. But I think the problem is that the contraction, the drag from the weaknesses behind, the recovery is still getting somewhat delayed. But nonetheless, I think this is a set of basket where I feel downside is quite protected. And if there is recovery, I think this is probably the next phase where recovery should happen. And there could be upside that can potentially come through in the space per se. Sonal.
All right, Prateek, thanks a lot for joining in, sharing your views on the consumption space in general and some sectors that you are positive on as well. Prateek Parekh there from Nuvama sharing his views on the consumption basket. Meanwhile, there was some flash